Check AB1. Check AB1. Check BA1. Check BA1.
stage is yours. Sorry. I have to announce the next team. So the next team up is Trinity University.
Okay, hi everyone. My name is Dwani Jane.
I'm Quinn Medak.
I'm Brandon.
And I'm Stella Conroy.
And we're from Loyola Marymount University, and today we'll be talking about recalls as entry signals for Riverdale investments. So 25 years of recall data tells us a story that isn't so obvious from just the headlines. And the question that we ask on behalf of Riverdale Investments is, does risk recall remain the same across US manufacturers and non-US manufacturers? And if it isn't, then what does that mean for how you position your portfolio? The reason we look at non-US manufacturers is because if you don't look at it, you don't know whether you're seeing an industry-wide pattern or something unique to US manufacturers specifically. Both groups are fundamentally different in how they generate risk and how we can predict it. And today we'll be walking you through that difference and how to act on it specifically. So to start with the most basic question, who is filing and how often? Well, before I do that, I want to clarify how we have defined non-US manufacturers. We have clarified it as a parent company whose primary listing is on a foreign stock exchange. With that being said, on a per firm basis, US files more average recalls than their non-US manufacturers. And what is more telling is actually the shape of that activity over time. So if we look at the chart on the right, we can see that the total share of recalls doesn't gradually increase, it spikes in 2014, 2015, and again in recent years. But those spikes aren't just noise. They align with concentrated events that then create a buying window. Whereas non-US manufacturers are more steady, with more consistent filings, more companies, but there's no single moment of acute pressure. And that difference between event-driven and steady state is the basis of everything we'll be showing you today. So we know that US firms file more per company, but when they do file, how big is the impact of their filing? Non-US firms affect more vehicles in total, which makes sense because we found 13 non-US manufacturers and only 3 US manufacturers. But their exposure is spread across years and manufacturers, whereas US exposure is a little different. It concentrates. And we can find this in the 2014 GM ignition switch crisis, which was the largest OEM-driven recall in the history of the US. But we excluded Takata here, which is an important note that I want to make, because Takata was a supplier-level defect, and it doesn't tell us anything about individual OEM risk. And what remains with that is a single company absorbing an enormous amount of shock in a single year. But that kind of sudden pressure, that concentrated pressure on one single stock is exactly what our investment thesis is built on.
And so we drilled down into the specific components that are defecting and causing these recalls. And we did this by breaking the defects into 4 classifications. And why this mix of defecting categories is important as a proportion of total recalls is because one recall is not like the other. So for example, a recall that's classified as electronics and software will actually impact 3 times as many vehicles as one classified as mechanical per recall. And so we really looked at, with the US manufacturers and the non-US manufacturers, what's failing. And the result was nearly identical between both of these groups. So as you can see here, the proportions of total recalls are very similar. The one thing that did stand out was that initially it looks like the US OEMs actually had a higher proportion of that electronics and software category, but this is entirely attributed to Tesla. And we actually excluded that in our further analysis and our predictive recommendations because it trades less like a vehicle company. It really is in its own league and it's not comparable to the others. And so we also looked at, again, these recall volumes over time, but now broken down into component categories. And the most significant finding we have there is that the electronics and software category, as a proportion of total recalls, has actually grown by 23 percentage points since the early 2000s. And so this growth in the electronics and software category is affecting both the U.S. and the non-U.S. manufacturers, but in different ways, and this is the important note to make. So if you look at this left graph, you'll see that the electronics and software category spikes in that one spike there in 2014, and this just clarifies what Duani was saying, that these recalls are very event-driven. And so this rise in electronics and software in 2014 is again event-driven, and this made up 60% of the total recalls in 2014. Whereas when you look at the non-US manufacturer group, this rise in electronics and software is actually chronic and gradual, as you can see by the red columns there. And so there's no spike to isolate, and there's no market reaction to really capture.
As Quinn just stated, the nature of risk is shifting more towards software and electronics across all regions. But then that raises the question, who is most exposed to that risk? And our heat map breaks it down by company and defect category. As you can see at the top, non-US firms dominate across the top 3 companies, Volkswagen in powertrain, Hyundai across 3 different categories, and Stellantis in electronics. But with such broad risk, it's harder to predict what company, what category, and what quarter the next recall will occur in. And as portfolio managers, such broad and distributed risk is hard to time. Whereas US risk looks a little different. It's narrower, and it sits between 2 companies, Ford and GM. Both are flagged as outliers, which means that it's 1.5 times the peer average in their respective categories. And that's not a coincidence. It's a structural pattern in a set of firms that you can actually monitor and act on. And that is somewhere the next critical recall is likely to happen. And for Riverdale investors, it is exactly the entry signal to watch out for.
Right, so based on the severity scoring, we conducted an event study which led us to our final investment recommendation, which is to hold on foreign manufacturers and invest in GM and Ford. So what our event study looks at is the 120 days after a critical recall. And what the event study really shows is that that $1 million position that you take can significantly change depending on who you invest in. So first, taking a look at GM and Ford, you can see in that 20 to 40 day range, you see the market price in a dip in response to that recall. And this is exactly the time frame that you would expect, because investors and analysts need time to digest and react to the magnitude of that recall, which is why we see that dip there. However, what's more interesting is that the market actually prices in a recovery, and by day 120, your investment would have made $42,000. On the flip side, when we look at the foreign investments, we see that it's more of a steady and slow overall decline. And there's a couple of reasons for this. So first, as Duani mentioned, foreign manufacturers have a higher rate of occupant protection recalls. And a flag like that signals consumer safety risk, and consumer safety risk is followed by lawsuits, repairs, and overall a more persistent financial damage. On top of this, we also have to take into account information leak, which is the idea that information has to travel from NHTSA, US financial press, to international analysts, and then finally that's going to take effect in the market. And what the result is that steady, sustained bleed. And that's not exactly appealing for investors. So clearly the opportunity here is in the US with Ford and GM, and Stella's going to tell you exactly how to take advantage of that.
Yeah, so like Brandon was saying, investing in the US is where we're recommending, and there's 2 ways that implementing both will be important. Implementation 1 is shorting isolated US critical recalls. That's in those Ford and GM critical recalls. An isolated critical recall is a recall that doesn't have any critical or high recalls the prior 16 trading days. Our recommendation is to buy on the short. You buy within 1 trading day of this recall coming out, and then you hold for 5 days and exit on that 5th day. This will get you an average of 3.4% revenue on just that short. So there's clear exit and enter taken into account along with risk filter, creating the optimal place to earn quick profit. Then there's the long-term plan. This is the long-term strategy based on Ford specifically. Ford, when they release a critical recall that has when their market is an R squared over 0.35, for the 200 days prior on their trading stock, that shows that there has been no market shifts in their stock specifically, meaning that this critical recall is likely to have a drastic change. This is going to happen, and then you buy in within the first 3 days. You hold for 60 days, and then you exit at day 60, which is predicted to get you an average of an 8.34% return, which is much better than those random picking, which had a 0.34%. With this model, we found an 89% hit rate with one miss in 20 years. Using this model, it is the perfect place to understand exactly where Riverdale can take large investments, but also be able to have strong risk limitations with no judgment, no ambiguity, and straight exit, enter, and risk filter rules. Thank you so much, and we welcome any questions.
Judges, please.
Amazing presentation. Good job. I have two questions. So the first one is I want to ask you about the heat map that you were showing and saying that Ford, GM are actually in the negative bracket. I'm curious how you curated the data set, meaning is it because there are many cars that are being produced? That's why we are seeing Ford and GM standing out, or something else going on here?
Yeah, thank you for that question. So we think that Ford and GM stand out here because the way that we calculated our severity rate on a scale from 0 to 100 is we took into account both the severity by when we looked at the text of the descriptive fields, and we're taking into account, for example, if it were to say there was a death or it said park outside or do not drive. But then, like you were mentioning, since Ford and GM stood out, that's likely because we also took into account taking the log of the recall count specifically, and these two had the higher recall counts individually. And so that's why for their severity, they still had really high severity scores.
Okay. So the reason why I'm asking is maybe they may have a lot more customer base compared to the other companies, so that's why I was curious why this is happening. But my second question is kind of follow-up of that. So when you go to the, I think Stella was the one who was talking about, can you go to the next? Yeah. So you are suggesting, from this data set that we should invest in US-based car manufacturing companies. But I was just looking around, different reputable sources, but majority of the people living in the US, top 5, Toyota and Honda are also the major car companies. So where is the trade-off and what do you recommend?
Yeah, so thank you so much for that question. That's really what we kind of dove into, and we took this in a way of looking at the direct stock change, and we noticed that with the foreign where the cars are considered, which is Toyota and Honda are considered foreign in our model, those stocks are less predictable, and there's a lot of noise. When we were doing a lot of machine learning testing, it was basically flip of the coin, whether it's gonna hit or it's not gonna hit, and that's why we recommend just to hold. We also saw that even though there was a lot of noise, there was a much more predicted downhill slope, which we can see in our appendix. Next one. Oh, next one. Oh, just kidding. But basically it doesn't really project to recover is what we found, and for those foreign ones, so that's why we don't recommend investing. We don't necessarily recommend pulling out, which is what Brandon said. We recommend keeping that hold because it's basically flatlined, but those US-based ones are the ones that we can project.
Thank you. So basically, this is remaining Q&A session, and so we're good.
Thank you.
So, Trinity University, please come up. And the next team up is Manhattan University. So you have one, you see down here, and yes. The clicker is here. Oh, you saw it.
All right. Good afternoon, everyone. Thank you for all being here. First, to start off, I want to bring up the word recall. So, initial thoughts when it comes to recall, most people probably think of manufacturing issues and defects in vehicles. Well, in today's auto industry, it's so much more than just that. This can kind of nowadays lead into issues for when it comes to investing confidence. It kind of decreases that and could bring issues financially and also supply chain. Today, my name is Luis, and with Ryan, Luke, and Kwong, we're presenting recall risk across borders, U.S. versus non-U.S. automakers. I'll pass it on to Kwong.
All right, so Riverdale came to us with one core problem. Does manufacturer origin actually predict the recall rate? So to answer that question, we asked ourselves 5 questions. Are high severity recall trends between US and non-US manufacturer converging over time? Which groups show greater high severity recall exposure? Which defect categories most differentiate US and non-US manufacturer? How do financial markets react to recall announcement across US and non-US firms? Do repeated recall change how investors respond to future recall announcement? So are the trend is converging or diverging? Looking at this chart from 2000 to 2015, where the 2025, where the non-US is represented by the blue line and the US manufacturer is represented by the red line, we can easily see that in the first decade, both lines are stable and close together. However, the Takata airbag crisis then hit in 2014. One supplier, one major problem, and both lines spiked at the same time. This already tells us that the recall risk doesn't care about the manufacturer origin. So along with that, the Takata crisis lasts for a few years, and the increase in the technology component also has contributed to the increase of the recall. And for me, let me hand it to Luke for the next one.
Okay, so yeah, as you saw in that graph previously, there was a remarkable increase over time. But what we also did was look at the severity distribution between U.S. and non-U.S. markets. So this was not given to us by the data set, but we used role-based text analysis to come up with these 5 different categories, ranging from 1, which is very minor, like labeling issues, to 5, which is very critical and life-threatening. And as you can see between these, the percentages between U.S. and non-U.S. manufacturers is not very different, especially as you get towards severity 4 and 5. As you can see, it's a 2 and 3% difference respectively. And so these are not isolated based on U.S. and non-U.S. manufacturing. Okay, and then this is a heat map based on the component categories. So we kind of consolidated them into 7 different categories. And looking at the occupant safety, which is the largest percent of the recalls, we can see the non-U.S. manufacturers have a 5% increase in that category, and that has to do with the fact of the Takata crisis, and that disproportionately affected the non-U.S. markets. Also, looking at the automated driver category, we can see that there's also a 3% difference, and that has to do with the fact that the U.S. manufacturers were more earlier adopters of the automated driving systems. But overall, as you can see, they're very similar to each other, and that has to do with not only the fact that they have similar engineering to them, but also the fact that they have they're similar in their recalls as they're mandated by the National Highway Administration to report these for both. And as you can see, this is another line graph, but this is a fleet-adjusted recall exposure. So basically, this is adjusting for the fleet size. So obviously, different manufacturers have a different amount of cars on the road. And so this is just It's just adjusting for that so that we can have a more cross comparison between the two. And as you can see, they cross each other multiple times. There's not really a time where one is dominantly higher than the other. And that also goes to show, similar to the map that was before, looking at U.S. versus non-U.S. manufacturers doesn't give us that much information regarding recall risk. And now I'll pass it to Ryan for the modeling.
Thank you. So this leads us right into our next question of how are financial markets affected by recall announcements across U.S. and non-U.S. firms? If we look at the 3-day announcement window, we can see that the average abnormal return gap between U.S. and non-U.S. companies is about 0.38%. And with U.S. having a higher percentage, it shows that they absorb recall announcements more positively than non-U.S. firms. And this is shown against all time horizons that we tested. At the 60-day mark, U.S. stocks are generally flat. Non-U.S. stocks are down about 0.6%. It's also important to note that this gap actually narrows as severity level increases. Next, let's look at how repeated recall announcements can impact investor psychology. What we're seeing here is the economic theory of rational inattention. So as companies continue to issue recall after recall, investors know that risk is already priced in. However, for first recall offenders, as shown here and here, there's a different story where the stock might drop in the US by about 2%, and then over a 60-day time horizon will have an excess return of up to 14%. We trained a logistic regression model on 15 years of stock market and recall data, and our goal was to understand whether we could predict whether to buy or sell a stock based on a recall announcement that would realize a 60-day return higher than a peer index of other manufacturers. Our result was we tested it on data from 2023 to 2025. We had 10 buy signals with an 80% hit rate, 7 sell signals with an 86% hit rate. Our sell signals, notably, they are all Ford. This is not a coincidence. Ford issued 150 high severity level recalls between 2023 and 2025, which our model picked up. Important predictors included whether the company was EV primary, severity level, and total number of cars affected. And we are presenting this as a screening mechanism that investors could use rather than a direct rule to trade upon.
So based on our findings, we have a few recommendations for Riverdale investments. First, we decided that they should weigh supplier concentration, recall severity, and regional exposure as compounding risk factors, as we found that non-US manufacturers absorbed high severity more negatively. Our action plan for that was to diversify the auto portfolio across supplier segments and not just the manufacturers. Second is to evaluate the recall risk relative to fleet size, as we found that just having the true counts of per manufacturer kind of shows you more of the size of your company, and having the fleet adjusted exposure will tell you more about how to how fairly compare both. Third is to monitor non-US recall trends as a forward-looking risk indicator. And for both, our action plan is to incorporate vehicle on-road count to quantify recall risk. This will be very important for the risk analysis and making sure that you are properly looking at the right numbers. Fourth, for Riverdale, they should distinguish chronic recallers from first-time recallers. We found that, for example, Ford, GM, or Ford and GM all have since they have so many recalls pretty often, that the risk is sort of inside of their stock prices. And fifth, to use recall signals to prioritize investment team research. As Ryan was mentioning, to use our model not as a way to trade, but instead as a sort of way to flag and also learn more. And our final call to action would be to apply our buy and sell model with monthly refreshes. And so, yeah.
All right, so we didn't just want to present our finding to people. We want to actually give Riverdale's something that they can actually use. But for some reason, right now, our QR code got restored while transferring to PDF. So I have the link here. It's called trinitysim.lovable.app, where everyone can try it right now. And throughout this link, it can tell the Riverdale investment team where to look before making any position. And yeah, thank you so much for your time.
Thank you, team. I have one question. So when you're comparing the US versus non-US manufacturers and how the market reacts to it, you are assuming a 60-day window to both markets. Was there any consideration on using a different time window for US versus international markets?
Sure. Great question. We used a 60-day time horizon because it was about the median, we'd say, where stocks can adjust and correct for any recall announcement.
And that was based on some analysis that you did, or was it just anecdotal?
Yes, yeah, we tested out a few different time horizons on our logistic regression model and before that.
Okay, thanks.
Thank you.
Hello. Oops. Hello, can you hear me? Oh, okay, I'll keep talking. Hi, thank you for your presentation. Oh, turn it on. That works. Yes, hi again. Thank you so much for your presentation, Trinity. I just wanted to go back. I guess Takata kept coming up. So my first question is, during your data preparation and exploring, did you consider, since Takata was only in the non-US population, did you consider taking it out and maybe doing a separate analysis of it? And if you did you notice that when you removed it, that it was similar, the distributions for the two, by any chance?
So correct me if I'm wrong, but the Takata airbag crisis affected, it was a global scale thing, so if it also affected the US market, so just if we kind of didn't explain that right. But yeah, it affected the entire market.
So in your data set, it affected both markets?
Yeah.
Yes.
And my question on separating it out, did you, like when you explored, did you see any difference between those two in the actual airbags? Was it huge when you removed Takata specific?
So I think the reason why we didn't remove Takata specific, because I believe that a lot of US manufacturers also use the airbag from the Takata. So both of them have the same supplier. So that's why they kind of moved in the same way when it's come up about that recall.
Okay, thank you.
Great presentation. Quick question. Earlier in the presentation, you mentioned that you created your own recall categories from the text. Can you give a double click around the methodology that you used to create those?
Okay, so what we did was it was called a role-based text model. So basically, we have like these. It was a custom program in Python where we had these bunch of words that said, like, for example, for severity 5, fire, explosion, that sort of thing, and we matched it to those, and then we had to go back because it was misclassifying them. So we had, because for some of them they had like risk of fire, and so that classified it as 5. So we had to go back and like make sure it was actually like classifying it correctly. So it was a custom-made program.
Thank you.
Thank you.
Thank you, guys.
Thank you. Okay, before I ask the next team to coming up, so I want to let everyone know that this particular presentation, this set of presentations, so are live streamed. So if you want to tell your parents, like tell your friends that I'm showing off myself here, so please do so. And the next team up is Manhattan University. And after this presentation, the next team up is the Tech de Monterrey. Yes, Monterrey. Thank you.
Good afternoon, everyone. My name is Keneal.
I'm Catherine. Oh.
Sorry, now I'm Jonathan.
Sorry, can I X out of this? Okay.
And we are representing Manhattan University. auto recalls are known to be bad news. They harm the reputation of a company and also provide a clear message of poor quality. However, how does this affect investors, and does it really matter whether the manufacturer is American or foreign? To answer this question, we ran a data analysis on more than or nearly 10,000 different personal vehicles across the span of 2020 to 2025. For our presentation, we have split 8 different categories. That being, we're going to set the stage first, then we're going to explore structural differences, then we're going to jump to, nearing the end, we're going to jump to manufacturer recall risk score, and then we're going to end on our key findings and recommendations for investors. So just for some context, we see that starting from 2000, both U.S. and non-U.S. manufacturers have had exponential growth, and which we see a turning point in which in 2013, around non-U.S. manufacturers had higher recalls for the first time. And in 2025, we do see as U.S. had jumped to around 250 recalls per year, and that was their highest recorded. And this just shows the underlying driver of recalls is complexity, in which today we see lots of new components, technology, and interconnected global supply chains. When looking into the different characteristics of recalls, we see that on average, U.S. trades at U.S. has higher volume of recalls, but however, as the ranges sort of overlap, there isn't consistent. One isn't consistently as bigger than the other. In our top components by recall count, we see mixed components coming in first. We see electrical systems coming second, and following with steering service. And what I believe to be the most important is our recall severity distribution, in which we see a 89.9% of high severity amongst non-U.S. Manufacturers, and for U.S. manufacturers, coming in around at 84.5% of high severity, so both having fairly high severity. But this reflects around a 5.4% gap, in which holds despite both of these markets having to comply with the NHTS regulations.
This slide tells a clear story of convergence. When we look at the scale of a recall, measured by potential vehicles potentially affected, we see that the difference between U.S. and non-U.S. manufacturers is essentially indistinguishable. The distributions overlap almost perfectly. Recall severity follows a similar pattern. Over the last 25 years, recalls have become more severe for both groups and rise in the same upward trajectory. The reason is structural: global supply chains and shared component suppliers. When a major supplier fails, every brand that has ties to that supplier gets pulled in. The implication is simple. U.S. and non-U.S. automakers are financially indistinguishable in many ways. They face the same macro engineering pressures and failures, the same regulatory landscape, and the same systemic risks. This brings us to our most important question. If operating realities are converging, what does the market do with this information? To answer this question, we ran an OLS regression on cumulative abnormal returns over a 10-day event window following recall announcements. The results are definitive. Our U.S. manufacturer variable produced an estimate of 0.001 with a p-value of 0.4, statistically insignificant. Recall size, on the other hand, produced an estimate of negative 0.0006 with a p-value of 0.004, highly significant. Ultimately, the market doesn't care about where a manufacturer is headquartered. It cares about the scale of recalls. How many vehicles are actually being affected? The business implication from these findings becomes clear. Investors penalize operational scale. rather than firm origin. Companies should focus on communication and recall management rather than nationality. These findings bring us to yet another question. Does the market react the same to repeat offenders? And to answer this, we first look at the market's amnesia. The market has amnesia. Historical recall frequency has minimal impact on market reaction. We plotted historical recall count with 5-day abnormal returns, and the relationship is essentially 0. The market doesn't care about the firm's past. It cares if investors are pricing current events, not the cumulative past. Second, recalls aren't isolated events. We analyzed when recall announcements happen and found that they occur in clear clusters, far more common than they would in a purely random prediction. When a defect hits a major supplier, safety campaigns cascade across multiple brands within just a few days. And critically, who announces first matters. Cluster leaders face far steeper market penalties than followers for both US and non-US brands. Followers, on the other hand, face little to no market reaction because by the time their announcement comes around, the systemic risk has already been priced in. This creates a clear trading signal that helps us build our risk score.
Thank you, Catherine. So what I want to get into is that we build a scale from 0 to 1 being more riskier manufacturer than 0 being less riskier as a manufacturer. Okay, sorry. So one of the things is that we took 5 major components, so scale, severity, completion rate, component danger, and frequency. So those 5, we merged them into, they're all equally weighted, by the way. So we took that and then we made it into regression, and what we got is the top 3 being Ford, GM, Chrysler for US brands, then General Motors. I'm sorry, I repeated General Motors. For European, it is European and Asian is Honda, Volkswagen, Toyota, Nissan, Mercedes. There's Porsche, which ranks the lowest. We did our regression on that. And basically what this does is it helps Riverdale investors to use this as a scale to see which manufacturer is ranked the riskiest to invest in, and also help them see which one is the lowest see the riskiest to not invest in, and then invest in the lowest one. So as Catherine mentioned, there's three empirical findings, which is symmetrical market pricing, statistically irrelevant origin. So what this means is that no matter where the manufacturers are, really don't discriminate on the manufacturer where their headquarters are. So operational coverage is how they deal with the recalls. US deals with technical recalls, mainly recall fixed, and then for non-US they deal more with physical recalls, and they fix that faster. So one of the things is this doesn't go in order, by the way, for recommendations, investor recommendations. It is do not value manufacturers based on country. No matter if it's Asian, European, or the US, do not base that on your findings. By the way, the p-value of this was 0.427, so obviously has no effect. Treat cluster as differently from leaders to followers. Always invest or look into followers in a sense instead of leaders. And deploy the MSSR scoreboard that we showed right here as a scale to help you invest in. And then I want to take a pause moment to thank all of you guys for coming here and thank the judges. And overall, use the MSSR as a reference. Do not use this as a final statement. Again, we're not data scientists as you guys. But thank you for coming, and much is appreciated.
Thanks, team. Could you go back to the slide with the distribution of severity? I'm interested to hear how are you defining severity, because if you look at distribution, close to 90% of recalls are high severity.
Yeah, so we use keyword matching in our consequence summaries to create a 3-level severity score. So 1 being low, 2 being medium, and 3 being high. And essentially what we found is that severity on average is incredibly high. And that's largely due to, as Keneal mentioned, rising complexity. As cars become more complex, we're essentially dealing with rolling computers. And one small malfunction is never limited. It's now affecting the entire vehicle and becoming increasingly severe. Additionally, this is partially due to the NHTSA's wording in the consequence summary. They're very likely, if even there's a small chance of injury or some sort of severe malfunction, the consequence summary focuses on, the unlikely but possible. So consequence summaries may, for a smaller malfunction, may include it increases the risk of injury or crash, and those will of course skew severity. Additionally, I'll just point you to severity over time has been increasing since 2000, and again, that's because of the complexity in cars increasing.
So would that mean that cars are less safer as the recall severity is increasing?
Yeah, so I want to take a moment for that. So again, as she mentioned before, in reality nowadays, as Dr. Thompson has a Subaru, he mentioned how there's a lot of tech in that Subaru. And again, you're no longer buying a car, you're buying a computer. ECUs are updated from 2010 for AI automation vehicles. As you know, there's cruise control has been there for a while, but now you have cars where you go into vehicles that track your eyes to make sure that you're driving in the correct lane. So as we're getting closer to that technical field, there tends to be more severe and more danger risk parts. Also, with our poster, this is side off, we found out that there's technical components integrated into mechanical components that work as a domino effect, where if a technical component fails, something mechanical fails with that. A perfect example is electronic power steering, where if that fails, I went through that too. I had to fix that replacement. Where if that fails, the car it's harder to turn. You can't really work around with that. So,
okay, thanks.
Yeah.
Do we have question?
One more question.
Okay. So can you go to the regression slide, please? Yeah, so you mentioned that recall size is actually the most significant factor, but I was also wondering what is the target variable that you're measuring here? Like in the sense, what are you trying to predict? And is this because of the, there are more number of samples for this particular vehicle or particular recall type, so that's why this is coming up as significant? Just curious.
30 minutes to resolve this, please.
Oh, okay.
30 seconds. Yeah.
Okay, so we're predicting cumulative abnormal returns based on a market model that we created. And the recall size, that's controlling for every other factor. So for manufacturer, for severity, for US versus non-US. So yeah, it is.
Makes sense.
Got it, yeah.
Thank you.
Thank you, guys.
So the next team is Monterrey. Yeah. And the next team up is Lehigh University.
Thank you. Hi. 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 Hello.
This is not Lehigh. This is, so we have two for you.
Okay.
The next team up is Lehigh. This is Lehigh.
Great. Recall risk is not about who recalls the most. It is about whose recalls actually move markets. Counting recalls just isn't enough anymore. We have to take a deeper look into it, actually find which recalls move markets as well. Keeping this in mind, we launched the following question. How can we differentiate and move those recalls into market signals as well? We are Tecnológico Monterrey, also known as the Mexican team, and this is how we move from recalls to returns. So we had a data set of 25 years, 2000 to 2025, with over 6,000 personal vehicle recalls. Our event study pooled more than 4,000 cars, cumulative abnormal return, observations. And this phase specifically asked us to differentiate between US, domestic car makers, and non-US, foreign. So what we started is with over roughly a little bit below 30,000 raw filings, in which we found roughly about 8% of them were significant enough to make a 1% change in the market drop when that specifically event or recall happened. What that means is that the gap, the investors, don't have a system to tell those 8% apart from the other 92%. So the problem we find, it's not that investors don't have the information to acquire that recall information as well. At the end of the day, recall data is public. What we're trying to decipher is also, how can we separate that noise away from specifically the recalls that actually move markets? So we created this Python framework as well, this framework in general, with the data pipeline through a Python framework in Excel as well, cleaning the data that the NHTSA gave us and provided us. Afterwards, we did an origin clustering, as I said, between US and non-US manufacturers. Then we normalized the data set to take into consideration the scale and the scope of US manufacturers. This was done through a specific formula, through Excel. And then we did a statistical validation through a chi-square test, t-test, and difference in different tests as well, alongside a linear regression. And at the end, we had our market reaction that compares the car event study directly to the recall. So this is a brief overview of our scope in general, the world map. We have our ODMs, domestic brands, 9 of them in the US, our 18 EDMs, the European Union, and 6 Japanese, 2 Korean. That's basically what we found here. And what you have to keep in mind is that origin doesn't tell the whole story, okay? So we move on to our first warning in this analysis. As you can see, this has a clear address. The US may seem like it leads, but as I previously said, counting recalls doesn't make the whole story. More recalls doesn't mean more risk.
As my teammate just mentioned, more recalls do not mean more risk. This is a clear overview of our database and how we separated it between these two groups. We have non-US, which instantly stands out with plus 4K recalls, 26 manufacturers, and it represents 63% of the events, versus USA, which is plus 2K recalls, only 9 manufacturers, almost 3 times less than the other group, and 37% of the events. Now, this is not good because this would be a naive read. You need to take into consideration the scale, the production, the sales. That's why we decided to normalize this data. Keep in mind that different group sizes always demand sales normalized exposure. You cannot take into consideration only raw counts. That's why we normalized. After adjusting sales, we got the sales data from Bloomberg, by the way. We saw that non-US had 20.10 recalls per million sold, while US only had 12.70. So we decided to confirm this by doing a Welch t-test p-value that got a statistically significant result of 0.001, which means it's highly significant. So this proves that this is the first signal that survives normalization. Yes, there is a difference between these two groups, meaning that non-US carries plus 58 more frequency than the US brands. I already talked to you about frequency. Now let's move on to scale because we need to take into consideration these two looks. We saw that larger affected units per event, so we wanted to take a look into that differentiation between these two groups. Now, US had 1.72 million average affected, while non-US had 1.47 million. But affected per million sold just got a p-value of 0.093, but this is only directional. We're talking about large numbers. That's why we decided to do a logarithm, which led to us having a p of 0.001, which means it is statistically significant, and yes, there is a difference. So our insight was, non-US recalls happen more often, but US recalls tend to be larger.
At the next level, the split between tech and mechanical recalls looks practically identical. Both are very close to a 50-50 split, but this is very general because we are talking about just tech and mechanical. Tech recall made software, electronic systems, cameras, and mechanicals is suspension and things related. So if we want to find a good pattern, we need to look deeper into each detail. Also, we wanted to know if a change occurred after 2013. We chose this year because after this year, tech recalls were mass of plus 50%. But the result shows that it's not significant break. So the gap didn't break after 2013, and it looks structural and persist. Then we see the critical safety notice. This is something very important, that is to not drive and park outside. These recalls are more urgent than the normal ones. So this immediately can affect how the consumer act in their vehicles. We can see that for foreign manufacturers, it's the percentage is higher, but the result is just marginal. And park outside, it's not significant, the result. So we can say that the region of the recall doesn't predict the severity.
Let's move on to our defect fingerprint. Now, US and non-US recalls fail differently. We decided to test this by doing a chi-score test, which got a p-value which was statistically significant of 0.0093. That means it is a statistically distinct failure mix. It is a fingerprint to track. We chose our top 5 defect categories such as electrical and tech, powertrain, airbags and restraints, brakes, and steering and suspension. Non-US stood out in electrical and tech with above over index of 2 points. Could be because of Honda, and also US in brakes with a +2, and could be because of GM. So this shows that they are completely different defect patterns between these two groups.
So now let's move on to investing. So here is the formula that we use. This is CAR, cumulative abnormal return, which compares each manufacturer's stocks against the S&P 500 to isolate the abnormal movement linked to each event. So this is what we're going to be calling market reaction. We use a 3-day window because that's the standard, like in finance, okay? This is what Jarl and Peltzman, who invented the car, said is the standard used. Okay, so when we were trying to understand how CAR was affected by different variables, we started by origin. So we wanted to know if market react to the different origin against the non-US companies or the US. What we found was that there's no significant statistical evidence to say that this is right, that this is affecting the market. So we said, okay, this is something that we've been seeing since the phase 1 of the challenge. The market does not react to the type of defect. They don't react to the size of the event, neither to if it's mechanical or technical. So what is it that drives market reaction? So then we said, why don't we start crossing different variables in order to understand if this makes any change? So after we tried to cross every single variable against each other, we found just one that actually was significant against the market reaction. This was severity. Severity was built by an NLP model, which understands the context of each output of the recall and classified as if it is severe, because, I don't know, it was fire risk, or it was death risk. Those words were considered severe. And the other is the origin and filtered by the US and non-US companies. So what does this mean for investors? This means that if you're gonna invest, the best thing you can do is invest on the US market, because the market do not penalize the US.
I'll give you 30 seconds to wrap up.
Okay, so because this do not the market of the US do not penalize equally the foreign companies than the local companies. So if you want to invest, you should invest in companies from the US. That's the output. So recall risk is not a national story. It is an exposure, defect, and market reaction story. Thanks. This is Alejandra, Hector, Isabela, and myself, Maria. And that's how we move from return to recalls. Do you have any questions?
Okay. I have one though. So if you go back to the point on normalization, can you walk me through the rationale of how exactly you did that? Because you looked at cars sold,
Yeah.
What's the time horizon there?
Yeah, perfect. So during our event study, we pulled cars sold in America in that time window of 25 years out of Bloomberg and Yahoo Finance. And our formula for the normalization was the total amount of recalls per brand per year divided by the total sales of each brand to see the normalization of each brand for the
And
car
each
as well.
brand in the 25-year period or that year? Okay.
During the 25 period, yeah.
Could you see any issues with that normalization?
Actually, all the data was taken from Bloomberg, so we are confident that's something.
Okay.
Safe
It's
source.
a safe source, yeah. But yeah, that's our event study that pulled, 25-year window.
Yeah, but took us like 5 hours.
Thank you very much.
Another question?
We already
Yeah.
presented to you guys.
Okay.
Okay, great.
Okay. Thank you.
Thank you very much for your time.
Lehigh University, please. And next team up is St. John's University, Team 1. Team 1.
Good afternoon, everyone. Today we will be presenting recall activity across domestic and international automakers. My name is Aurora, and here with me today is Anna, Coy, and Adil. Our analysis was focused on vehicle recall activity between U.S. and non-U.S. automakers, how the market and investors react to these recalls, and also how AI can be used to help identify and guide these recalls. So our data came from the National Highway and Traffic Safety Administration. To start off, we separated the brands by U.S. and non-U.S. brands. We did this based off of the location of the parent company's headquarters. So for example, we classified Chrysler as a non-U.S. brand, considering its parent company, Stellantis, is headquartered in the Netherlands. Next, we created a severity scale from low to extreme. So next we created a data processing pipeline. We filled our missing component values in the component column using keyword matching from the description column. We then grouped those 33 unique component labels into 7 different categories in order to streamline our analysis and make our results more interpretable. And then finally, we categorized the corrective actions into 6 final fix types. Anna will now walk you through some of our analysis findings regarding recall activity between U.S. and non-U.S. manufacturers.
Thanks, Aurora. So as we know, we're going to use U.S. and non-U.S. data because we know that there are different regulations across countries that can affect recall patterns. As you can see in the first graph up there, this is looking at recall activity. You can see that non-U.S. manufacturers consistently have larger recall activity. Now, this could be due to stricter regulations, but it's also important to note that there's more non-U.S. manufacturers in our data set. So it could be up slightly from there. More importantly, we want to look at affected vehicles per million, in which we see that U.S. is consistently in pace with non-U.S. manufacturers, specifically with this spike in 2014, indicating that there's a larger impact and that even though they might have a smaller recall count, there's more severity per recall. Next, we want to look at component categories that drive recall differences. You can see that across both non-U.S. and U.S., that occupant protection, control systems, and electrical software are the key components, indicating that there are global issues affecting all brands rather than isolated incidents or isolated recalls that are related to one government regulation. Moving on, we want to talk about severity level comparison by recall count. You can see that critical is through mechanical failures is the #1 type of recall, but we also have a lot of recalls related to fire and explosion, as well as passive safety, and thankfully very few extreme level severity recalls. But lastly, I want to direct you over here. We're dividing it between not high severity and high severity. And you can see that non-US, again, has more recalls. But if you look, 55% high severity for non-US and 56% for US, indicating that severity is, again, distributed pretty evenly between the two, meaning that manufacturing groups does not play a role in severity. Next, I'll move it over to Coy, and he can talk about the key timeframes of interest.
Yeah, so I organized the entire time frame into 3 different time period. So it's help us better to examine how the trend of the recall from in the past to nowadays. So at the very beginning period, we could find that most of the recall were related to like basic components, which low in cost of repair, and gradually coming to more in the major size and pose a higher risk to customer and drivers. And to the last period, which will show like the transition into more of the technology, the software, the production of ran into like more EV and electrical vehicles. Before looking into deeper, we tried to examine like how the size of the volume of the recall changed over times. And we could find that in the middle period, it actually reaches its peak for both US and non-US car manufacturers. And also it's showing that for the last period, it seemed like it's gonna reach even higher, or at least gonna equal to the second period, including like the size of the recall. And when going too deeper, we want to examine like the component, how do they ship over time. And as you can see on this heat map here, as going forward to nowadays to the present, electrical component and software actually score more in the recall tendencies. For both US and non-US, for non-US will be 484 and US will be 193. And also we found that for occupant protections also scored the highest in the recall tendencies for the middle period. And Ade will walk you through the financial market.
So let's talk how market reacts on US versus non-US car manufacturers. First, we calculated the cumulative abnormal returns by basically taking data from Yahoo Finance and subtracting the S&P 500 return from the company's stock return. And we used 3 event windows, 2 days, 6 days, and 20 days. And as you can see on the graph, non-US manufacturers were consistently punished more than the US manufacturers, and actually US manufacturers performed better during those windows. And since the gap becomes cleaner to the closer to the 20-day window, we use the 20-day window for the later analysis. Here we analyzed the severity alone and actually saw that for non-US based manufacturers, high severity levels, the blue bar chart actually goes more down than the non-high severity, so they actually get punished. And again, for US based manufacturers, they actually performed better when there was a high severity. So we couldn't make any significant conclusions from this. And later we analyzed the recall scale, and we actually found it interesting as the affected vehicle volume size goes up from the left to from the smallest to the largest. The non-US based manufacturer stocks actually perform worse. But for US, the first 3 orange bar charts are positive, and the last one is very negative. So we assume that there is a certain bar between the large and the largest bucket that we made in terms of the vehicles affected, and invest market is tolerant towards the US-based manufacturers until they reach that bar, and as soon as they cross that bar of how many vehicles were affected, then they punish US-based manufacturers even more than the non-US-based manufacturers. And lastly, we saw that repeated severe recalls really affected non-US manufacturers, as when they repeated high severe recalls time over time, their average cumulative abnormal return went towards the negative value more. And overall, we think that investors should pay closer attention when investing for non-US based manufacturers, whether they have high severity recalls and on the recall size. And for US based manufacturers, we think that the market has higher tolerance, and there are just some extreme cases like the largest amount of the vehicles affected. So it can be more safer to invest in US based manufacturers.
So our initial analysis focused on where these recalls were happening, how severe they were, and how the market was reacting to them. But as we know, investors are not only concerned with the past, but they're also concerned with the future. So with that being said, we propose a multi-agent recall risk intelligence framework. This framework is composed of two branches. Branch A has our early warning agent. This agent uses the complaint data in order to flag and tell the user of emerging recall risks. In Branch B, we have our corrective action prediction agent. This agent uses the recall input and the prediction from the early warning agent to tell us what the most likely fix type for that recall is. Embedded in Branch B, we also have our validation agent, which tells us how reliable our previous predictions were. And then, after creating this multi-agent framework, we wanted to turn this into something more than just a concept. So, therefore, we created the Recall Risk Intelligent Assistant. As you can see, we have an example output of the UI of our chatbot on here with the sample input on the left. And we also have a QR code for you to try it out yourself. It should be noted that the purpose of building this chatbot was not to replace the analyst's job, but instead to be used as a recall support decision tool for them. And also, another note, this is a very early iteration of this chatbot, so we do welcome any questions, advice, or suggestions that you have for us. Thank you.
I want to remind judges, we do not allow handouts and all those actual components into the competition. So please do not judge based on the content, so from the QR code.
Questions? Great job.
Thank you.
I have a question regarding your severity score, because the entire focus is on using that metric that you created, and seems like you have two buckets of severity, right? So I'm curious, what kinds of robustness checks did you use to measure how good the severity score is? Because essentially you're deriving all the insights based on that score, and so I want to understand how you curated that.
Mm-hmm. So we tried out a few different models when we were trying to determine the severity score. We ended up using a text-based model and a logistic regression model, as those had the highest accuracies. They did all have pretty similar accuracies, but we decided to go with that one. And we also wanted to do 5 different categories, because we felt like anything less than that wouldn't really tell the story fully. So we felt like having the low to extreme 5 different categories fit best through the text mining from the data set.
And then using those 5 categories, we divided them to high severe and non-severe. The first 2 were selected and put into high severity, and the bottom 3 to non-severe. And then based on that, we made some analysis of the cumulative abnormal returns, but as I said, we couldn't make any conclusion from that because the difference was not statistically significant, and we extracted value from the recall size analysis and from the potentially repeated recall, high severity recalls.
So my question is, how did you measure that this metric that you are using is working? That's my question.
Working for...
So for example, let's say I have, the column that we have, recall description. So I'm assuming you are using that and using the text in there. So did you guys verify if the metric is actually scoring high versus low by looking at examples or using some sort of a metric? I'm just curious because, as you said, you start from 2, then went to 5. So wondering about the process.
Yeah, we ran some tests, but I think it was mostly for phase 1 for the poster, so we didn't include it here as we wanted to specify what actual steps we took for the phase 2, but we can actually talk about this after. We can show you our code for the test as well.
Thank you. Great presentation.
The last team to present is St. John's University team.
Thank you. Hi everyone, my name is Augusta, this is Dylan and Ryan, and we are representing St. John's University. So today our presentation is over finding the signal in US versus foreign automobile recalls. And here we've done a comparative investment analysis where we were asked to compare US and foreign automakers. And from there, we found that from the US recall data set based off from the NHTSA, that most of these manufacturers were foreign firms. So from an investment perspective, we were looking at how all these recalls were interpreted differently across these different markets. So this is our agenda that we'll be covering today. And from our recommendation, we have found the most amount of investment opportunity in the foreign automaker recall industry. And from this is based off two major factors. One, the shifting structure of recalls and the severity of recalls. So how we've been able to get that is by answering this question. Can US versus foreign automobile recalls patterns reveal profitable investment signals? And the short answer is yes, and we were able to answer that through comparing recall risk, secondly, measure investor reaction, and lastly, build a profitable investment strategy. And now I'm going to pass it over to Dylan.
Thank you. I'll be speaking on our data cleaning and methodologies. Essentially, we were able to take our 30,000 rows of competition data and shorten this down to about 5,400 market observations. We were then able to classify into a US versus foreign classification using ticker prices and keyword matching. Then we moved into a natural language processing classification system. We used this on our severity score and a technological versus mechanical failure label. We then performed a structural breakpoint analysis as well as an event study based off of a time-tested industry standard and two Q1 rated Scamago research publications. We were then able to take all of these findings and place them into a strategy simulation. So comparing the US versus foreign firms' characteristics, it is clear that foreign firms outnumber in total recalls. Foreign firms over the past 25 years have made up about 63% of the total recalls in our data set. However, the US leads within median affected per recall with about 9,000. As for components, the top three components were the same, consistent across both markets. Powertrain led, while safety and battery and EV followed. I'll now pass it to Ryan.
Thank you. So now we want to look at the structural shift over this period of 2000 to 2025. What we decided to do is run a bi-Perron regression analysis. So for the US market, we decided and found two structural breaks. The first being in 2013 and the second being in 2021, which created three regimes or periods. For the break in 2013, we found that what drove this was the Takata airbag crisis and the increase in safety like airbag and seatbelt recalls. And we labeled this the pre and the post-reform era. Now for the 2021 break, we found that the rise in tech and EV recalls is what drove that. Now picture yourself in a car 25 years ago. What the most electronical significant thing there may be a radio. Nowadays you get into a car and you have all sorts of things like lane assist, backup cameras, and even in some cars it seems like you have a computer in there. All these drove the significant rise in tech and EV recalls, so we label that the tech EV era. Now, when we go to our foreign market, we found the breakpoint at 2016. Now, this breakpoint is This was a breakpoint based off three major factors. The first one being, once again, the Takata airbag crisis and those safety recalls. The second was Volkswagen, and they had a scandal where they were not computing with the Clean Air Act, and they had exhaust problems as well as emission problems, and they had regulatory problems that go along with that. The third factor, and another major one, was Mercedes. What they did is they were not compliant with the NHTSA with their recalls, so once again there was more regulatory problems, which led to the pre-enforcement and post-enforcement era. Now I'm going to pass it back to Dylan.
Thank you. Essentially, for our severity scoring system, we were able to use a natural language processing model to find the true consequence of each recall. Using our top 3 weighted recalls based off of industry research through insurance researchers and liability, specifically the Department of Transportation's values of a statistical life, we were able to find our top 3 weighted drivers of fatality, fire, and explosion. We chose to use a natural language processing model over a traditional keyword matching system because, as we all know, there is a large difference between an explosion in your windshield wipers and an explosion in your engine. Moving on to the distribution of severity score by manufacturer origin, as you can see here, the shape is generally the same. However, as natural language processing severity scores increase on the foreign side, so do the number of recalls. This led us to creating our binning system in which we took the lower, middle, and top thirds of the severity score and created our low, medium, and high severity bands. This high severity band is where we found our main insights and signals. Back to Augusta.
So in order to find our signal, we ran an event study methodology. Like I said earlier, it's a time-tested industry practice method. So you can compare an event study just like analyzing a coffee shop sales. And one day, your favorite celebrity posts about it on Instagram, and the next day, you see the sales jump. So that difference of that increase of sales and comparing it to what the coffee shop would normally do tells you what drove customers in that day. So the same thing goes for stocks. You're comparing a stock's actual return based on its return after a recall announcement date and comparing that to what it was expected to do, like we have here against 2 different benchmarks, the MSCI World Index and the S&P 500. So now I'm going to pass it off to Ryan to go over signal selection.
Thank you. So as Augusta said, we want to differentiate that signal between the US and the foreign markets and see which is best to invest in. So when we did our event study, we did a -1 plus 7-day window. -1, that is just for some signals before, just to filter out some of that noise. And the plus 7-day window is backed up by some of the articles that Dylan mentioned before. So in that window, what we decided to do is focus on the 3 major factors that we went over. First is the structural break. For the foreign ones, we looked at the post-2016 structural break, which is the post-enforcement era. For the US ones, we did the post-2013 break, which showed the post-reform and tech EV era there. Now the next 2 is what we wanted to look at is the high severity model. The high severity that Dylan mentioned before, we classify that as our top 33% bin from our NLP model that we developed, and once again splitting it between foreign and US signals. So for our foreign signals, we wanted to look at 2 indexes. First, the S&P 500 is the base index in the USA that you can look at. We want to take a step further and look at the world index, which is used in 23 developed countries. When we compared the 2, we saw that it was significantly negative over that 7-day period of time. When you compared it to the US signal, we saw that even though there was a decrease of returns over that time, it was not really significant and showed no statistically reliable data for us to use. So what does that mean for us? The foreign market is the place for us to look for the signal. Thank you. I'm going to pass it on to Dylan. Oh, sorry. Now I'm going to continue and go into our investment strategy, which is our short of high severity and foreign recalls. So for this, what we decided to do is we're going to, when you look at a foreign stock abroad, you may see that the foreign stock is more risky because you have less information or news about it. And when you combine the high severity of it, where it's very problematic, you expect it to drop over that time. So for a short, on day 0, we're going to borrow the stock and sell it at that current market price. After that, when it hits the lowest at day 7, what we're going to do is buy it back, and the difference is the profit we make. We also included a stop loss feature to just signify the risk control of our model, as well as a robustness test, which when we use this, what the robustness test does is if you take any individual firm out of our model, it still shows significance and reliable results. Now I'm going to pass it to.
So Cumulative abnormal returns are great. However, we wanted to turn this signal into an actual financial number. So we decided to use a $10 million portfolio simulation across our 9-year backtest in the post-2016 era. We were able to find over this portfolio, we were able to find a $6 million total profit and loss with a 54.2% win rate across 756 trades over the period. We wanted to take this one step further and bring in the first 3 months of this year, in which, using the same portfolio size, we were able to find a total profit or loss of $108,000 with a win rate of 51%, statistically significant.
So this backtest is our green light. We tell investors that this where to invest is into short, high severity foreign recalls. And from this signal, we are able to build revenue building, reliable, and risk managed trading strategies that are backed by profit. Thank you so much for listening, and we're happy to take any questions.
Sorry. Thanks for your presentation. I just have a question regarding, I think from the beginning you had mentioned, it seems like, I take it you're going with the signal and the noise, and you mentioned, I guess, maybe about 3 or so outliers. I believe you said there was a scandal, there was a Takata, there was something else. How did you handle that in your data analysis? Did you exclude those? Like, how did you handle it before you started your modeling? And from what I understand, you did regression and you also use simulation later. Could you just walk me through that?
So that's a great question. So for those 3 factors that I brought up, that was in the foreign market, which shows in the structural break. When we determine the structural break, we wanted to find the reasoning behind that and not just use the numbers. So the reasoning behind that structural break in 2016 was the Takata airbag crisis, the Volkswagen scandal, as well as the Mercedes not being regulatory and compliant with the NHTSA. So we basically wanted to show that because of that, that's why it shifted during that time, because there was more regulations and different things that the NHTSA pushed out. So that's we kept including that in our data set because when you look at the structural shift, that was the breakpoint there.
Okay. And just walk me through your modeling techniques. So you said you used regression and as well as simulation. Could you explain?
So for the breakpoint regression, we were able to use a biparone breakpoint regression, which essentially identified these 3 statistically significant breakpoints for us. And those were used as essentially breakpoints in the data from which we were able to separate from the rest. So, yeah, and then for the portfolio, we were able to use a Python script that scraped the latest, that scraped the latest Yahoo Finance data and applied our trading strategy to the actual numbers. So every single number there was based off of what would have happened if we actually were able to put our positions in place.
Okay, thank you.
More questions? You good? Yeah.
Thank you.
Thank you so much.
Hey everybody, so basically this is the last team to present, and thank you for being here. Before I let you go, I want to express my appreciation again to our judges here, and
one more round of applause to our distinguished judging panel. I did briefly introduce the judges during lunch. I think some of you were not in the room. One more time, the full bios are posted on the website. So, and we have small gifts for the judges. We are not done yet with the judging process. So the judging deliberation will happen in a few minutes, but we have some goodies for you.
Oh, thank you.
Thank you, Paul. Thank you, Nika. These are like picnic blankets.
Thanks so much.
Sure. Thanks again. Just one more time, some housekeeping notes. So students need to check out. What time did they say? Between 4 and 5, or so before the dinner and the award ceremony, they must be checked out, right? And then there will be certificates for all the attendance, all the student attendance. So make sure to grab your certificates during the award ceremony. And lastly, your posters. If you want to take your posters with you, you're more than welcome. Or if you want to just take a picture with it before leaving, just talk to Karen in the front desk and she can help you with that. So that concludes phase 2, final round of phase 2. Dinner and the award ceremony starts at 5 o'clock in room 5B. Let us know if you have any questions. We'll see you soon. So I think I need a few minutes, and perhaps you need a few minutes before we can start the deliberation. So. Connect this first. I'll be using both outlets, or can I? Yeah, please.
Okay, so I will go here.
You have to make sure with
Sure. So I will go up here. You say the judges. And then we'll see you. And then take from here. Sure.
in my thank you list. Judges, student members, Karen, Sayed, and his group, and then committee members. Oh. Sure. Okay, so, but you can start with.
Okay. Sure.
Good evening, everyone, and welcome to our dinner and award ceremony. Today we celebrate the achievement, dedications, and excellence of the 21 teams participating in our 11th competition. I would like to congratulate all the teams for their great presentation and poster over the last 3 days. We are impressed with your passion and hard work. You are truly the future AI and data analysis leader, and we are honored to have you at Manhattan University.
So to start the award ceremony, I know you're excited to hear about the winners, but we have to make some acknowledgements and announce a few things. So first, I'll start by thanking our distinguished judges. I know some of them are still here. If you could please stand up to be recognized one more time. Tabish, Mika, Lydia, thank you. And oh yeah, we have all 5 judges here. Chantal and Paul, thank you so much for helping us with evaluating the phase 2, both rounds of phase 2. Then I should also thank our student workers. So the last 3 days, our student workers were helping us a lot day and night. Are some of them around? They did, so they're helping students with check. Yeah. So our wonderful graduate assistant who gave the valedictory speech a couple of days ago, right? Yeah. So she's graduating, and then she was terrific the last several months since we started planning for the competition. I think in August we started. So one more round of applause to Karen. Also, every time there's an event here, every event that the O'Malley School of Business hosts, our camera crew, Dr. Syed Kazmi, RJ, Ben, and Alexis, thank you so much for everything that you always do for us. So I also want to thank Dean Girgis, Associate Dean Grishma Shah, Provost Chalk, as well as Dr. Roy for all their support. One more time, thank you so much. And of course, I have to thank the organizing committee members who helped me and Horan. So Horan and I were the co-chairs of the competition. I'm not sure if how many of the organizing committee members are here. Dr. Musa Jafar, Hyun Park, anyone else here? And of course, our assistant dean, Aileen Furley. She technically retired from the post of assistant dean a few weeks ago. Well, we definitely needed her support, so she graciously helped us, and she's going to help us with the competition in the future, I hope.
One more year.
One more year.
More than 1 year.
Thanks again. So these are the acknowledgements. I hope I didn't miss anything. Do you want to take it, or?
Okay, sure. So the slide, next slide, is about search.
So the next slide
will be the best poster award go to.
The next one, actually, just before that. In the next few days, you're gonna get an. In the next few days, you will get an email with a link to a survey. So please fill out the survey. Whatever things that we could do differently, whatever things that we could do better in the next year, please let us know. Really appreciate your time and attention.
Can I go now?
Yes, please.
Are you sure? Okay. And the best poster goes to, first one, St. John's University.
So, you better go on.
St. John's University, Team 2.
So, yes, you're going to take pictures with this. So.
Good.
Yes,
Sure.
yes, please, yeah. Oh, sorry. So we are recognizing 3 teams for the best poster. So the order, there's really no order. 3 teams are recognized for their best poster. And I know one of your team members had a health issue during the competition. So. Oh. This order. Congratulations.
And the second team is Otter Bean University.
Do we have anyone from Otterbein University here? Yes, they checked out already.
And the third team is Rutgers University. Flip the slides.
Sure.
Sure. Wait until I announce. Sure.
Congratulations, Rutgers. So, before we announce the winners of the cash prizes, let's one more time. These are the 6 finalists that made it to the final round. So, whether you win the cash prizes or not, definitely that's a good bullet point on your resume. So, Lehigh University, Manhattan University, Loyola Marymount University, St. John's University Team 1, Tecnológico de Monterrey, and Trinity University of Texas. So we have one slide first. So out of these 6 teams, the cash prize winners.
Okay, we start with 2026 Business Analytic Competition third place winner will receive a $1,000 award, and the winner is Tech de Monterrey.
So this year's international team from Mexico won the 3rd place and the cash prize.
Congratulations.
Congratulations.
Okay. 2026 Business Analytic Competition second place winner will receive a $2,500 award, and the winner is Manhattan University.
So their advisor, Dr. Tomoyaga, couldn't be here because of a family emergency, so Holly helped us with guiding the team. Great job, Holly and the team. Congratulations.
2026 Business Analytics Competition first place winner will receive $5,000 prize, and the winner is St. John University Team.
Bridget, you should also take pictures with the top team, the top 3 teams, please. Yeah, sure. I want to also take a picture with that provost,
Yes.
Dr. Chalk, please.
Like when this is done, then make sure that you let the teams that won know that they need to go outside to meet us to fill out a W-9 to get paid.
Oh, okay.
Yes.
Yeah, we'll do it for that. Let's do it. We'll circulate the info in New York School, right? We'll do that.
That's right, that's right.
Mary should come this for the
Oh.
Correct. We do appreciate that.
Yeah, 1 second, maybe. And also the other top 2 teams, if they can also come to podium to take a picture, that would be great.
I'm coming. I'm coming. Okay.
Are we waiting on anybody? No. All right, looking right here. 3, 2, 1. One more. 3, 2, 1. Very nice.
You want to get one more thing, right? What do you think? The second place.
Second and third, please come up.
And maybe all 3 teams together after that.
And with everybody, just teams.
Ronnie.
You want us at this one or the next one? Okay, got it.
Off the side.
Karen?
I'm sorry. Alright, folks, looking right here at me. 3, 2, 1. One more. 3, 2, 1. Very nice. Third place.
And then take a look at the Monterrey. One more picture with the dean and provost, please.
Alright, folks, looking right here. 3, 2, 1. One more. 3, 2, 1. And then one more. 3, 2, 1. One check here. Very nice, thank you.
And
The top 3 teams.
the top 3 teams, one last photo, I promise.
It might work best if we put the text down. We'll have more space.
Now you can see
The advisors are- So we don't, yeah.
Yeah, just the team,
Yes.
their advisors, yeah.
That makes more sense, yeah. Do we have all 3 advisors?
Holly. Very nice. Alrighty. Looking right here, everyone. 3, 2, 1. One more. 3, 2, 1. All right, very nice. Thank you.
One last announcement for the cash prize winners.
Yeah, hi. If you could meet myself and Professor Fairley outside to sign a W-9 to make sure you guys can get paid, that'd be great. The 3 cash prize winners, please. Thank you.
If you fill out the tax forms.
We still want to share.
Yes.
Yes, I want to make this. Done, we're done. Oh, you want to do one more thing? Here's my, I have to ask one, I have to do one more thing that I don't want to.
So that concludes the award ceremony and back at MU 2026. Thank you everyone for attending. Hope to see you again next year.